The Fed cutting interest rates by 50 basis points with broad support from the committee. And joining us now with his reaction, former Boston Fed President Eric Rosengren. Great to have you. Eric, I found it especially interesting that Fed Chair Powell said the 50 basis point cut sends the message the Fed is determined not to get behind the curve. You see it that way?
Well, I think it's taking an action that makes it more likely that we have a soft landing. I was a little surprised they went with 50. I thought they were going to do 25. But I think he gave very good explanation for why they did 50 this meeting. It was really in two parts. The first part was that the employment data has been a good bit weaker since the July meeting. And had they known how much weaker the payroll employment would be, they might very well have acted back in July. And the second is he used the term recalibrate several times. And I think what that reflects is they've had more progress than they expected on inflation. The employment data has been a little bit weaker. And so they wanted to get the Fed funds to be less tight, to be more reflective of the current economic conditions that the economy is facing.
So we haven't had a dissent from a Fed governor in almost 20 years. What does it mean that we got one from Bowman this time?
Governor Bowman's been very hawkish for some time. And most of her public speeches have highlighted her concern that we continue to be over our 2% inflation target and that we should really see lots of evidence before we react too aggressively. So she wasn't dissenting against easing. She was dissenting against easing by 50 basis points. So I think it just highlights her own view that she'd like to move more gradually until she is very, very confident that we're going to hit our 2% inflation target.
I want to step back and ask what is perhaps a very basic question, and that is, what does a 50 basis point cut do to help buoy a softening labor market?
So it helps in a number of ways. As your last session just discussed, it does help on housing. So it helps both supply and demand. It helps demand because some people who couldn't afford a house at 50 basis points higher now will have a lower interest rate that may make them, particularly for first-time home buyers, able to buy into the house. The second thing is, as rates come down, people aren't going to feel as locked in, which gives them flexibility to move and not feel the regret that, well, I'm leaving a very low interest rate mortgage, and even though this is a better house, it's just at such a high interest rate, can we really afford this move? So I think it does help out in the housing market, particularly with improving the volume of home sales. Second, consumer loans and car loans have been quite high. They moved up quite a bit when the Fed was moving their restrictive policy. And I think 50 basis points is going to start providing some relief on that. Finally, I would say that I think it gives more confidence to businesses that the Fed is not going to get behind the curve, that it's going to try to orchestrate a soft landing, and they can have more confidence in their investment decisions going forward.
And how to think about balancing rate cuts in what is now an easing cycle, or I guess an easing cycle towards a normalization, against the fact that the Fed is continuing to let assets run off its balance sheet?
So I think both of those are consistent with getting back to a more normalized Federal Reserve policy. So because inflation had gotten so high, the Fed became unusually restrictive. Those conditions are no longer necessary. So they are starting a cycle which, if the summary of economic projections is right, they're going to have two more 25 basis point easing at the November and December meeting, and then probably 4 next year. So that just highlights that they are confident that they are now have inflation under control. And so we are going to be in an easing cycle. But he also made very clear that, the speed at which we move to that is going to depend on economic conditions. In terms of the balance sheet, they've been normalizing the balance sheet for some time. And as he highlighted in the press conference, we're not quite there yet. The goal is to, again, we don't need the same level of accommodation on the balance sheet as we did when the economy was in a much weaker position. But the balance sheet is a very slow-moving The changes in the balance sheet have to be more slow moving because by intent, they're trying not to affect the economy by the shrinkage of the balance sheet. They want the primary tool to be the federal funds rate.